We have a great presentation lined up for you today with some awesome speakers. But before we bring them on, I'll just do a quick overview about what we do here at Sense Financial. My name is Dimitri. I'm the founder and president of Sense Financial Services. I will be your host today. And just a little bit about us. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. We've been serving clients since 2010. We go out of our way to provide our clients with excellent service and exceed their expectations. We got hundreds of five-star reviews all over the place, and we actually helped over 3,000 clients establish over 4,000 self-directed retirement plans over the last 14 years. Most of our business comes to us through referrals. So I see many clients on the webinar today, and we got a few new folks joining us as well. So that's great. Just a quick overview of the benefits using a self-directed IRA and solo 401k. You will be able to invest in alternative assets, meaning you can achieve true diversification. Investment returns are sheltered from taxes inside of a traditional retirement account, pre-tax account. And if you utilize in Roth, then you get to enjoy tax-free investing. You can also leverage your funds by utilizing non-recourse financing. We specialize giving our clients ability to have checkbook control. So this way you can either bypass the custodian in a case of an IRA and truly have control over your IRA funds, or with solo 401k, you don't even need a custodian. So that's a great way to control your retirement funds. Solo 401k also is a great tax shelter. For this year, you can contribute over $70,000 and shelter that from your income. So if you're a small business owner or self-employed, this is a great tax strategy to employ. And with self-directed retirement accounts, you can do a lot of things. You can invest in many things, but there are a few limitations, and I'll quickly go over those. They're described in the Internal Revenue Code Section 4975 and the prohibited transaction rules. And essentially, it says that your IRA funds cannot be invested in collectibles, in life insurance contracts, and in addition to that, your retirement account cannot engage in any transaction with disqualified person, which is yourself and your immediate family members. Unlimited investment options, meaning you can invest your IRA beyond the stock market. You can do real estate, residential, commercial. You can invest in tax liens and trust deeds. You can invest in precious metals, cryptocurrency. You can use your IRA or 401k as a bank and lend money to others. You can do private lending, invest in trust deeds and mortgage notes. And that means true diversification. So you're not going to be like a man and a woman, the man holding the basket, which represents the stock market, and all the eggs are gone because they're in single basket, and it wasn't stable. So the bottom fell off and all the eggs are gone. So, and you can accomplish true diversification by utilizing self-directed retirement account. So with this, just a quick overview about what we do here at Sense Financial, but the topic of today's presentation is on powerful tax strategies for real estate investors. And tax strategists who specialize in helping people use their real estate to save massive amounts in taxes and keep their hard-earned money. They help educate investors on how to maximize tax write-offs, legal entity strategies, tax-efficient ways to access profit, and how to use 401k money for real estate, and much more. They also authors of the highly rated book, Tax Strategies for Savvy Real Estate Investors, and they have been featured in prominent publications including Forbes Finance Council, Money Magazine, Tax at Google, and as well as Bigger Pockets podcast. So today, Amanda and Matt have helped thousands of investors nationwide to save on taxes with proactive tax planning. So they're truly experts, and I'm excited, just like you are, guys, to hear what they have to say. So Amanda and Matt, welcome.
Yeah, thanks, Dimitri. Thanks for having us. I appreciate it. It's good to talk to you again and see your face. We know we run into each other at events throughout the year and stuff. So thanks for having us. Look forward to kind of hopefully giving everybody some good nuggets of information today.
Yeah, can you guys see my screen? Maybe we'll just do that test again for a thumbs up if you can see it.
Thumbs up, not like middle fingers or anything. Just
you guys are good.
Thumbs.
Yeah, big see your screen.
No middle fingers.
Yeah.
All right, so excited to be here, guys. Like Dimitri said, we are CPAs who specialize in working with real estate investors. We are investors ourselves too, so really excited to be here to share some strategies with all of you here.
Well, we are not. We're not CPAs that are good with technology, so you got to give us a second while we figure this out. But
I know, like, where did my slides go? All right, I can see our slides, but we can't see you guys, so hopefully we're all going to be good. But yeah, I love that you guys are all here learning about self-directed investing. Today we're going to talk about tax strategies specifically for real estate investors. We're going to touch on some of the tax benefits of self-directed investing, but I know you guys already probably learned a ton just from Dimitri and just your time with him on the do's and don'ts of self-directed investing. But I just want to share something interesting. I was actually talking to a client of mine yesterday, and we were talking about how they could still contribute to the retirement account for last year. So like they have an S corporation, they have a solo K, they have until the date that they file the S corp return to make the contribution. So that could be as late as September of 2024. And what's really funny is that they talked to their financial advisor at Merrill Lynch or Fidelity, one of those, and she said, I want to do it for real estate. Can I do it here? And financial advisor, Fidelity, or Merrill Lynch rather, said, yeah, of course, you can do that here with me too. And so she double checked with me, and I was like, no, you cannot do real estate with Fidelity. What they're talking about is probably a REIT or something like that, but you can't buy a property on Main Street or Fremont Street with your self-directed IRA. So, so much misinformation out there, which is really great in terms of why you guys are here to learn with Dimitri about all the benefits of self-directed investing.
Yeah, and I think probably 85-90% of our clients are real estate investors, and I'd say probably, if I had to guess, I'd say probably half of those have self-directed retirement accounts as well. So it is very common in our practice. It's what our clients understand. It's what they like to invest in. That's why they do it. And so, yeah, we'll be talking about all kinds of good stuff today. So hopefully you guys can walk away at least with one or two things you guys can implement in your own situation and take back and keep building that wealth.
Yeah. All right. So let's start with, we just sort of touched on like the fact that you can still fund retirement accounts before filing your tax returns. So for those of you with solo case, make sure you understand that. But I think one of the most important parts about why we're here is really understanding the power of tax savings.
Yeah. I mean, there's this quote that an old previous judge, his name is Justice Learned Hand. And yes, that is a real name. But he said in America, there's two tax systems, one for the informed and one for the uninformed, and both systems are legal. And so the point of this is we want you guys to fall in that informed category, right? In that informed bucket where you can take advantage of the tax code, utilize it to your advantage. Because really at the end of the day, it's an incentive. It's a set of incentives that the IRS or the government is trying to give us. They're trying to incentivize you to do specific behavior, invest in real estate, build businesses, whatever the case may be. So it's all about taking advantage of that to the best of your ability so that you can, cut your tax bill, use that money, reinvest, continue to build that wealth, right?
Yeah. What's really interesting, there's an organization called Tax Foundation, and it's a nonprofit that's been around since the 1930s. And so every year they do analysis to see where are taxpayer dollars going, where are the highest taxing states, how much are we losing to taxes. And interestingly enough, for the last several years, the results has shown that U.S. taxpayers lose more money to taxes than we do on food, clothing, and housing combined. And so, we were pretty shocked by hearing that year after year, especially because now, we're kind of in the lower tax rate years with the Tax Cuts and Jobs Act. But let's take a look.
Those were air quotes.
Yeah, we're in the lower tax years.
Right.
And so if we take a look at the silent killer of our wealth, we can take a look at all these different tax rates that we pay. These are currently the highest marginal personal rate is 37%. We all pay state income taxes, unless you're one of the lucky few who lives in the tax-free state. But California right now, the highest is 13%. We have clients in New York and Hawaii pay very similar or higher taxes. Those of you who have a job, you pay payroll taxes too, and that's taken out of your paycheck before you even see it.
Yeah, and then real estate investors or your people who are selling stocks. I mean, part of your tax you're paying is obviously capital gains taxes, so that can be upwards of 24%. That might even go higher if some of the current budget proposals get passed. And then if you pass away without a good estate plan in place, you could pay 40% in estate taxes on the appreciation of your assets that has occurred over the years. So you can see right there, I mean, just those alone, you can see why people are spending so much in taxes. I mean, this doesn't even include property taxes, sales taxes, anything else, any other gasoline tax, whatever else there is, right? So you can kind of quickly see why it does add up so quickly that people would be on average spending more money on taxes and food, clothing, and shelter combined.
I think also what's interesting, I think a lot of people don't know this, and we haven't really talked about this a lot, but by the end of next year, okay, so starting in January 2026, the tax rates are actually going to increase. So without any tax changes, the tax rates will automatically go back up, I think to 39% for individuals. And it's going to be cutting the itemized deduction by half. A state tax exemption is being cut down back to 5 million. And so it's really, really important for us to not just tax plan for now, but tax plan for the future as well. I mean, if you're trying to figure out what does this all look like, we have a really good pie chart that we put together.
Super technical.
If you made $500,000 of profit or of income as a W-2 earner through your investments, this is typically what's left after paying taxes, about $199,000. So all that black part is what's taken away in taxes. Again, using today's lowered tax rate. So pretty shocking. It was just the reason why, we're here today, right? It's like Matt said, is the government incentivizes us to do certain things, invest in real estate, build businesses, create jobs, and save money towards retirement. That's why when we put money towards retirement accounts, we get the tax benefits of deductions, and it's growing tax deferred.
Yeah, I'm curious as to how many of you have maybe heard that phrase like, the more income you make, the more taxes you have to pay, right? I mean, I'm raising my hand because I hear people say that all the time, right? But yeah. But it's interesting is that that's not actually the case. We do tax planning all the time. We're working with our clients to find ways that you can be making same or more money and actually cutting your taxes by utilizing real estate and other tax strategies. But interestingly enough, New York Times came out with an article, I think it was probably a couple of years ago now, where it was talking about Bezos and Bloomberg and Elon Musk and how these super uber wealthy people are making so much money, and they are allowed to take advantage of all these super secret strategies because they make so much more money than everybody else, they can't utilize these strategies because they're just not those people, right? They just don't have the same number of zeros behind their income.
It's like the tax secrets of the super wealthy, and it's unfair, and we can't take advantage of those. Title. What?
It's Tax Secrets of the Super Wealthy.
Yeah.
All right, write that down. Don't take our title. Don't take our title.
And what's really interesting is, of course, Matt and I, being the tax nerds that we are, we dug into the article, try to figure out what exactly were they talking about. And to summarize it for you guys, the basic premise of these super secret strategies that they talked about really boils down to three main categories. And we call them the 3 Ds. So it's deductions, depreciation, and debt. And we're going to cover all 3 of those today on our presentation or in our class. But at a high level, just before we start talking about the details of each, if you think about it, these are things that we as real estate investors use all the time, Okay, but the article talks about that from the perspective of these large multinational businesses, and where they can take deductions for all their businesses and investments that they have. They take depreciation on their real estate and their buildings and their assets. And these super wealthy people get to use debt. Like they get to borrow money without paying taxes, and they even get to write off their interest on that money. It's like
crazy.
Atrocious.
It's
How
crazy.
unfair for these people. And of course, these are things that we do like all the time as real estate investors, right? So we'll start with deductions, right? That's the kind of the pillar of tax savings, is really getting an understanding of what we can write off. And I think investors, we're all very creative people. Many of you are more creative than Matt and I, because we're also accountants, so less creative. But people are always having these creative strategies on like, how do I get deals? How can I do financing? And which is all great, but nonetheless, people are always very confused about what can we write off. And I think investors are really good about writing off property specific expenses like interest and taxes and more, management fees. But more often than not, we see people missing out on some of these overhead expenses that we all have with respect to rental real estate that are not property specific.
Yeah, I mean, some of them that come to mind that we see a lot is, professional development, business training, education expenses. A lot of, investors and business owners are spending money every year to kind of keep expanding their knowledge base. It keeps expanding their business, learn new ways to do things, get new funnels for, incoming leads, whatever the case may be, right? So this is a lot. This is money people are spending every year. And the point being, too, is that when you're looking at maximizing deduction, we're not looking at going out and just spending money to get a tax deduction.
Because that's just silly.
Yeah.
Right? Nobody wants to do that.
I mean, if you want to do that, you can just give us money and take a tax deduction for tax prep fees or something like that. So, but besides that point, but this is money you're spending already, right? So we're looking for ways to take things that are maybe before were non-deductible, maybe personal expenses, and convert them into legitimate business deductions. So again, you go into conferences, you got education, you've got dues and subscriptions for different meetups and groups that you're part of, business meals. You're going out to lunch or dinner with a colleague or a realtor or potential investor, and you're talking about business. As long as you're talking about business before, during, or right afterwards, that meal's a tax deductible expense, right? Maybe you're traveling to a conference again. Maybe you're going out of town. I mean, this happens a lot. We see, we do speak at various conferences throughout the year, and we'll see clients there, and we'll fast forward a few months, or looking at their tax returns, like, hey, I know you were at A, B, and C conference. I don't see travel expenses on your return. What's going on? It's like, oh yeah, sorry, I paid that with my personal card. I forgot to deduct and blah blah. We've heard it all, right? So, but these are the reasons why I think some of these expenses are overlooked.
Yeah, and that's a really great point too, is this happens a lot where people personally pay for expenses without thinking about it, and then later on just forgetting about it. So even if you paid with personal funds, these could be legitimate business deductions, as long as you can prove that they're ordinary and necessary for your real estate business. So the expense does not have to be paid from an LLC or a corporation for you to get the tax benefit. So I know, Dimitri, we hung out with you in Vegas in the last year, so I'm hoping you've locked in your Vegas deduction, your Vegas trip deductions there. So, along those same lines, again, what are some of the personal expenses that we already have, but we are also using for business purposes that we can shift into legitimate expenses? Home office, car expense, those are two of the most common ones that are missed. If your CPA is still telling you that home office is a red flag, then you definitely need to seek out the advice of someone else. The IRS has changed their position many, many years ago. In fact, over 90% of our clients operate from a home office. We have almost less than a dozen clients who actually rent an office space to deal with their rental properties. So just make sure you take advantage of that if you have an eligible office. Same for car expenses. People tend to think I can only write off my car if I'm driving to the property, but that's not true at all. There are a lot of other business trips that don't involve you going directly to the property, like going to real estate conferences that you're driving to, meeting with potential investors, going to the bank, going to Home Depot. So just make sure you track those. The higher income tax rate you're in, the more impactful the tax savings are. So if you're someone in California, let's say, and between federal and state, you're paying close to 50% in taxes, well, $1,000 in deductions found could save you $500 in taxes, right? So it does add up over time. When we talk about shifting personal expenses into business deductions, obviously one of the biggest expenses that, many of us have are kids. And so one of the things we're always looking for is how can we incorporate our older kids, maybe they're, teenagers or tweens and teens. I think they're called tweens. I don't know. Tweens and teens that are older, what are some of the ways they can help us in our business, and we can take a deduction for the money that we're going to pay them for it.
Yeah, especially as they get older. I mean, we have a 12-year-old who's going on 18 or something, it seems like. But, as they get older, obviously they become more expensive, right? They've got friends, they want to go out and do things. And so, we all know that we're giving them money anyway. So why don't we get them to help us in our business, hire them to help do some work in our business, pay them, take a tax deduction for that. And then they can use that money to go and spend money on their friends or movies or music or whatever they spend money on, video games. But again, it's money that we're already spending, giving them, right? So if we can take a tax deduction for it, so let's say we hire, you got 2 kids, maybe you pay them each $5,000 if that's reasonable for what they did. You got a $10,000 deduction, maybe that, 50% bracket saves you $5,000 in taxes. On the flip side, every individual can make around $13,000 a year and not have to pay any income taxes. So on one end, the parents are getting a tax deduction. On the other end, the kids don't have to pay any income taxes on it. That's a win-win. So instead of giving them $10,000, now we've effectively only given them, $6,000 or $5,000 in our example, right? So it's definitely a way to get some tax savings, and obviously, teach them good working habits at the same time, sense of responsibility. Who knows? Obviously, teenagers are probably better at social media and marketing and other things like that for your business than, better than I am for sure.
Mm-hmm.
Maybe not better than her, but better than I am for sure.
Thank you. And yeah, when your kids earn income, they could potentially put into their own retirement account, like an IRA or Roth IRA, and have it be growing tax-free. I think 2 questions I know we will get, so I'll just answer it up front. How old do my kids have to be? Well, there's not really any requirement from the IRS's perspective. The IRS just requires that the compensation is reasonable for the work. However, different states have different requirements and limitations with respect to how many hours they can work and what kind of work they can do during school versus in the summertime. So really great resource for you guys to check out is Department of Labor. That's DOL.gov.
Sounds like a super fun resource to check out.
Department of Labor, guys, that's where we're going right after reading the publication that Dimitri shared earlier on the IRAs. So DOL.gov is a place to go. And on that website, they actually have a map. And so you can click on a map of where you live, your state, and it gives you a summary of what are the state law in terms of employing your kids. And so it's a really, really great resource for you to check it out. And, another common question we get a lot too is, do I have to have a legal entity to use any of these, like write-offs and pay my kids and all that kind of stuff?
Yeah, I think if you take away anything from this talk today, the one thing I want you to remember is that it's not necessary to have a legal entity to take tax deductions. So repeat after me. It's not necessary to have a legal entity to take tax deductions. They repeat it.
I don't think so.
Okay. But yeah, it's
catchy.
Yeah, sorry. I was just mumbling on my mouth. But yeah, all these things that we're talking about, the point being is that you can take the same deductions whether you own a rental property in your personal name, if you own it through an LLC, if you have an S-corp business. A lot of these tax deductions are all the same. So now there might be reasons to have a legal entity, for your rentals for like asset protection reasons, but it's not necessary from an income tax perspective. Okay, so that's really important because, that's probably one of the biggest misconceptions out there, especially if not to make fun of lawyers, but we'll make fun of lawyers for a second, is, we've all been to those events in November, December, and someone's telling you to run to the back of the room to create your entity to save on taxes this year. And that's about the farthest thing from the truth, unfortunately. So,
yeah. And you have to also be careful too, right? Not just the cost of the entity formation itself, but the cost to maintain it. We have clients, in California and different parts of the world, or even Nevada, that have very high state fees associated with the entities that you create every single year, not to mention the bookkeeping costs, the tax return filing fees involved. So we're not saying don't have legal entities. Obviously, there are tremendous benefits of having entities for asset protection. But like with anything else in real estate, it all comes down to a cost-benefit decision. And that's what you need to make sure you work with your advisor on. Don't go out and form a bunch of entities just because that's what worked best for Robert Kiyosaki or Brandon Turner, right? Because it's going to be different in your scenario. So always talk to your own advisor before spending a ton of money on entity formation.
And Amanda, before I continue, I just want to make a quick comment. I think I learned this from you guys over 10 years ago about setting up a Roth IRA for your child. So I employed my daughter probably 10 years ago. Over 10 years ago, I opened Roth IRA, and she's getting ready to go to college now. She's 17 senior, and she has almost $100,000 in her Roth IRA. And over half of that is growth. So it doubled over the last 10 years. And there you go. That's college paid for. So this is a great idea.
That's amazing.
Yeah, you didn't tell anybody this, but I heard you say this right when we got on, is you want to help people open 100 Roth IRAs for their kids over the next month. So this is the challenge to everyone listening today, is to do that with Sense Financial, right?
Yeah. I mean, you can still fund, IRAs and Roth IRAs all the way up until April 15th. So still plenty of time to do that. Of course, they had to have earned income last year. So that's pretty powerful. I think that's the most amount of money I've heard in a Roth IRA. But I think the reason is because, like you said, you started 10 years ago. And so I think people tend to think, I'm going to put 5,000 in there. Almost seems like not much. What can I get? But when you look at it over time and with growth, it's super impactful, right? And so she's 17. I mean, how much is she going to have when she's 30? Or when she's going to retirement age? That's like generational wealth that your daughter can probably pass on to her kids or her grandkids. So very powerful stuff. Now we can't talk about.
She can send us a bottle of whiskey when she's 21, old enough to buy one.
All right, so we can't talk about real estate tax benefits without talking about depreciation, of course.
Yeah, I like to say, the depreciation is like the ninth wonder of the world. At least it is in my mind. From a tax planning perspective, this is why we love real estate. This is why we love, as investors, why we love real estate, because we can buy properties that are, obviously, hopefully cash flow positive, but with enough depreciation, the very minimum, don't have to pay any taxes on our cash flow. That's a lot different, obviously, than investing in the stock market, right? You go out and buy Google or whatever stock you buy. We don't get to write that off right now, right? We don't write that off until down the road when you sell the stock. But that's the beauty of rental real estate. I mean, the IRS is essentially giving us this paper write-off every year under the premise that the property is like, under normal wear and tear, it's kind of, going down in value. But obviously, hopefully, we all know it's going up in value. So that's the beauty of it. I mean, with residential properties, we can write it off a building over 27 and a half years. Commercial or non-residential is 39 years. That's awesome because, again, it can shelter cash flow. But there are ways with the right strategies you can kind of almost supercharge depreciation through like cost seg studies and bonus depreciation and things like that. So it's pretty powerful. Definitely something you want to look into maximizing when you deal with rental real estate.
Yeah. So that's the second D where we talk about deductions, we're talking about depreciation, and that third, super secret strategy of debt really works well together. And I think the best way to demonstrate it is to go through an example. So let's say you had $100,000 to invest. And like Matt said, right, you could buy an all cash property for $100,000. Matt just talked about this, accelerated depreciation we can take. So maybe we can get a $20,000 depreciation, which is really amazing, right? In other words, it means the first $20,000 of net rental income, you may not have to pay taxes on because we got 20,000 of these paper losses that we can offset. But let's say you're interested in using some debt. So my $100,000 could instead be a down payment on $500,000 worth of real estate. And so with a $500,000 property, if we use kind of standard, estimates, we might get $125,000 of depreciation in that first year. So you can see how leverage, right, debt and depreciation really works well in our favor for those of you who are using leverage to invest in real estate. And we'll take it a step further. Let's say that
Let's get crazy.
You're super comfortable with leverage. You're like, you know what? I'm going to keep my $100,000. I'm not even going to use it. I'm going to do a no money down real estate, or I'm doing some seller finance deals. I'm just going to buy $500,000 worth of real estate with no money out of my pocket. Well, guess what? The depreciation is still $125,000, because depreciation is based on a agreed upon purchase price of a property and not how much down payment you put in. So you can see how these super wealthy people that we saw from the New York Times article, they use the same strategy, but they're talking businesses and we're talking real estate, right? It's about tapping into the equity of what you've built up already through our home, through our existing rentals. We tap into the debt. We don't have to pay taxes on it. We then use that and leverage to buy more real estate and get more depreciation. So again, not super secretive, not super unfair. These are things that we all use day to day as real estate investors, but it's just a matter of being more intentional about it and understanding how to put that to work for you.
Yeah. And again, this is, taking advantage of, cost segregation study and bonus depreciation. I mean, if your goal is to be Elon Musk, you can just add some zeros to these numbers, right? You can get the same results. Now, an interesting question that's come up a lot recently is we kind of mentioned bonus depreciation. It's a big question. Is that bringing it back for 2023? And this is not a typo. I know we're talking in 2024. Some of you have already prepared your tax returns. Some of you might have even filed your tax return for 2023. It's like, wait a second, are they changing the tax law for last year? Possibly.
They could be.
They could be. So there's a proposal going through there that they are looking to bring back bonus depreciation and make 100% bonus retroactive to 2023 and make it effective for 2024 and 2025. Currently for 2023, it's 80%. 2024 is supposed to be 60%. So we do hope they bring this back, but we're hoping they bring it back sooner than later, because just like you guys, we have clients who are trying to file their taxes and claiming bonus depreciation on eligible assets, and they want to file their return to get their refunds, right? So now what we are telling clients is if you are somebody that is eligible to utilize bonus depreciation in your 2023 return and the numbers are significant enough, you might want to just get your return prepared where it's 95% done, and make a decision at that point in time. Do I file as is, get my refunds now, or if it's a big enough delta where it might make sense to wait till the IRS makes a decision on this, you might want to hold off on filing, just so you don't have to file an amended return down the road.
We talked a lot about all these like write-offs and depreciation and bonus depreciation. Inevitably, the result then for most investors is we get a tax loss on our rental properties, right? Not meaning we lose money, but just we end up with a loss on the return because of all these strategies. So then the question then is what happens to those losses? If you're someone who makes, 100 to 150,000 or less, usually for your rentals, you can use up to 25,000 of these tax losses against your W-2 or other income. And that's just kind of available for everyone. But if you're someone who makes over $150,000, then typically rental losses are passive losses, which simply means that they will offset all of your passive income. And if you don't have any passive income or more losses than you have income, they carry forward into the future. So you can use it to offset future taxes from passive income or passive gains. Now, the variation to that is if you or your spouse could be a real estate professional, because if you could be a real estate professional, then your rental losses offsets all types of income rather than just rental income. There's a whole set of rules regarding, who can qualify as a real estate, how many hours, what do you do with it. We won't go into super detail on that. We can reserve time for Q&A for those of you who have questions about that. But you can always just go to our website. We have a lot of content on what is real estate professional. You can also Google it. But at the heart of it, to be a real estate professional, one of the harder rules to meet is someone has to earn more hours in real estate than their W-2 jobs or their businesses that they operate full time. So in other words, if you are a high income earner, you're unlikely to qualify as a real estate professional unless if your spouse can. If you're a business owner and your business is not real estate, it might be hard for you to meet a real estate professional because you have a full-time job. And
it has nothing to do with whether you are licensed as a realtor or real estate agent or anything like that. That's a misconception.
Yeah. You have to have the right amount of hours in real estate properties. And again, one of the harder hurdles to meet is more time in real estate than your job. But the rules are a little bit different for those of you who are investing in short-term rentals or interested in investing in short-term rentals. And the reason for that is No rhyme or reason. The IRS just came out and said short-term rentals, Airbnbs, they are different than long-term rentals. And so you don't have to be a real estate professional. And this is a really powerful strategy for some of our clients who are still working a full-time W-2 job, but real estate is sort of a side investment that they do. They're going to maybe have some short-term rentals they self-manage, but they don't really have a ton of hours where they have more hours in short-term rentals than their job. But the benefit here is for short-term rentals, you don't have to be a real estate professional. As long as you meet material participation hours, you can use rentals from your short-term properties to offset W-2 and other business income, even if you're not a real estate professional.
Yeah. So again, the benefit is we're using short-term rental losses that we strategically created through maximizing deductions, income shifting, maximizing our depreciation. We're trying to use those losses to offset our other income, whether it's W-2 or business income. Now, interesting, for tax purposes, a short-term rental is defined as where the average customer stay during the year is 7 days or less. So it doesn't necessarily just because you're putting on Airbnb or Vrbo, that doesn't mean it's a short-term rental. It's if the average stay is 7 days or less, we got a short-term rental. If it's 8 or more, likely you've got a long-term rental, and that's going to fall more into the real estate professional arena. But again, the short-term rental kind of loophole or strategy is really powerful for people that Amanda said that are working full-time. Maybe they got kind of self-managing their own short-term rental or short-term rentals on the side. It's a great way to kind of shelter a good chunk of income each year that you can kind of turn around and reinvest and continue to build wealth so you can get out of the rat race sooner.
Yeah, and there's 7 different ways for you to qualify for the short-term rental loophole. We'll just talk about maybe 2 of the most common ones. So one is you earn at least 500 hours in your short-term rentals. So 500 hours you managing, dealing with your short-term rentals, that means it becomes non-passive, so you can offset all types of income. The other way, if you don't have 500 hours, is you can earn 100 hours or more, and nobody else has more hours than you. So an example could be your cleaning crew earned 800 hours.
800, wow.
Let's say your cleaning crew earned like 80 hours and you earned 100 hours, then you also would have met material participation. So again, very, very powerful for those of you who have high W-2 income. Real estate is sort of a side investment and really trying to use it to offset taxes in a pretty significant way. And of course, I said, we're not going to touch too much into like the retirement tax implications because I think all of you know a pretty good amount. But really, when we, for us, because most of our clients are real estate investors, the hurdle for most people is like, I would love to put money towards your retirement account and save on taxes, but I'm a real estate investor. I don't like the stock market. I want to put my money to work for me in real estate. And that's what we love about self-directed investing is you can have your cake and eat it too, right? You get the best of both worlds through self-directed investing. And, whether it's a IRA or 401k, when we put money in, we get contribution deductions. And the money, once it's in the account, it's going to be growing tax deferred as well. So really, really powerful. In a retirement account, we don't have to worry about paying taxes on that. We don't have to worry about 1031 exchange or any of that stuff. It's already built in where it's going to be tax-free or tax deferred.
Yeah, and one of our favorite vehicles inside the retirement arena, Dimitri was talking about the solo 401k. For those of you who kind of have a side hustle, you're earning some like active income, like 1099. Maybe you're a real estate broker on the side. Maybe you're selling stuff on Amazon. Some sort of side business other than rental real estate. So rental real estate won't, qualify you for a solo K. But if you're kind of doing some sort of side business and earning money, you can take advantage of a solo K. I mean, one of our the advantages of the solo K maybe over a SEP IRA or traditional IRA or Roth IRA is that you can have higher contributions, right? With the solo K, you have 2 buckets. You've got the employee bucket you can contribute to. You've got the employer bucket that you can contribute to. So that's pretty powerful. 401ks, solo 401ks, you can borrow against it generally for any reason. So that can provide extra liquidity if you're looking to you need to do things, buy more real estate, whatever the case may be. If you're buying leverage rental real estate in your retirement accounts, there can be extra taxes you have to watch out for. It's this UDFI tax, but believe it or not, if you do this in a solo 401k, that tax does not apply versus if you do it in like a traditional IRA. Don't ask me why. Maybe it's a Dimitri, maybe he got that passed through Congress years ago. I'm not sure, but it's pretty awesome thing.
Yeah. And of course, investment options, within the retirement account, Dimitri talked about all the different sort of almost unlimited asset classes you can invest in. And so for our clients, what we see the most type of investments in direct owned real estate, which is like single family, duplex, things like that. We see it in syndications, so apartment syndications, mobile home parks, commercial syndications. And the third one that we actually love is in note investments. What I love about note investments and retirement accounts is that when you're a note investor, there is no depreciation anyway. So if you do it in your personal name, there's not a lot to write off against it. And interest income is actually taxed at your highest ordinary rate. So because there's not much deduction and tax at a high rate, it's ideal for retirement accounts too.
So before we kind of take some time for Q&A, I kind of wanted to put some numbers to it so you can kind of see what, tax planning in action, for lack of a better term, right? And this is based on a client situation. We were kind of looking back on some numbers. So this particular client made about a little over $310,000 in consulting income. Obviously had a good year. Looked at converting some of these non-deductible personal expenses, turn them into legitimate business expenses for them. That was a big chunk of cash. It added up. So that was a little over $40,000 there. Did some income shifting with their kids. Took advantage of some car and home office, nothing crazy. Didn't let them wife talk you into buying a new Tesla or anything like that. But that was my inside voice.
I think the biggest piece for this specific client too, though, is that being able to fund retirement accounts, right? So they were able to fund retirement accounts, a solo K, and get a tremendous amount of tax savings from it, as you can see with maximizing write-offs, income shifting, solo 401k. So that brought their income all the way down to, I can't see that number, 187.
Yeah.
And so you can see a very, very massive tax savings. And the reason we wanted to put this all together is because, sometimes we go over concepts like, oh, great, I can pay my kids. Oh, that's fine. Oh, I can write off a home office, but maybe that's not much. Okay, I can put some money in a retirement account. But how much can I really do? But when you add all the pieces together, you can see how this could change the profile pretty significantly with respect to somebody just, using some of these traditional strategies. And this example doesn't even use real estate, right? So because this particular client wasn't a real estate professional just yet with respect to their rental property, so they were passive. But we have a lot of examples like this one where the spouse is a real estate professional and the taxable income is actually zero at the end of the day because they're using some of these cost segregation and other things that we talked about. But it's really important to understand that the tax strategies, they don't just happen by chance. It's always with proper planning, okay? And we can tell you, because we are CPAs ourselves, if you think your CPA is doing tax planning for you right now, like in March, April, when you're having them file your tax returns, you are 99% going to be wrong. AICPA just came out with their study that said CPAs on average are working 60 to 80 hours per week in tax season. The problem is getting worse too, because so many, 75%, I think, of CPAs are retiring. So people like Matt and I, we're getting all the work in from all those retiring CPAs. And so the work hours add up. And that just means, if you imagine yourself working 80 hours a week, that's like 16 hours a day. When you're meeting with anyone, you're not having extra time to think about tax planning. Okay, that's why I highly encourage you outside of tax filing time to meet with your CPA and figure out what are some of the things you can do proactively to save on taxes for this upcoming year. Because, in 99% of the time, it's not happening now when you're filing last year's tax returns. And if there's anything that we talked about that was kind of new or newer to you, then scan the QR code on your screen. This is just directly from our website. You can get access to our tax savings toolkit. We cover a lot more about real estate professional strategy, the short-term rental tax loophole, how to pay your kids and get a write-off for it, legal entity considerations. You also have a tax opportunity finder. It's basically a self-assessment tool that you can utilize. I think it's a set of about 8 to 10 questions. You answer them and you get an idea what is your current risk of overpaying in taxes. And what I really love about that tool is you can use that as a guide. When you meet with your CPA, you can bring that to them and say, hey, here's how I scored, and here are some things that I think I can maybe improve on. And you can use as a starting point for your discussions on what are some of the things that maybe I can do better for next tax season. So that's the end of our presentation. I'm going to hand back the floor to Dimitris to see if we can answer any questions we might have.
Thank you, guys. Great stuff. Just to everyone who are there joining us, this is the time to ask your questions, and you can do that in the Q&A session there. You can just type your question, and I'll read that for Matt and Amanda to answer. So first, we'll start with Will. He says, I have the books. I think he's referring to your books. So I love them. One of the questions I had was around the deductions that come with traditional real estate versus those owned in the solo K. I own both versions, in solo 401k and out. What benefit is there to expanding my holdings in the solo K?
Great question. So all the deductions that we talked about really are for non-solo K assets. So your own rentals or rentals that are owned like in your LLC or in a partnership with someone else. In your retirement account, we're only writing off things that are related to the property. So you're not going to claim a home office in your retirement account. You're not going to pay your kids from your retirement account. That's one of the prohibited transactions under IRS law. So really the expenses in the retirement account are just going to be like interest, property taxes, if there's management fees, depreciation. But most of this overhead personal / business is going to be outside of your retirement account.
And then, what's the benefit of expanding the portfolio in there? I mean, I think it just goes back to kind of what we were talking about earlier. Is like, with respect to investing your retirement money, where do you think you're going to get your best return on investment? If that's buying more rental real estate in your solo K, then so be it. If that's doing some of that and investing in mutual funds, then so be it. If it's not investing in real estate and buying mutual funds, I think you'll be one of the few on this presentation to think that, but that is an option, obviously. So.
Well, I'd like to add to that because this is a question that I get asked quite often too. And I want to piggyback on what you, Amanda, said about doing private lending inside of your retirement account. And I learned that myself. I started doing private lending with my personal savings. And then, as I continue to do more and more, at the end of the year, I will get a 1099-R. And there's actually zero write-offs. Not that there's not too many write-offs. There's zero write-offs for interest income. So what I experience is that my taxes only have gone up. My tax liability have gone up every year that I continue to do private lending. So I shift the strategy and I started doing private lending using inside of my retirement account. And I totally agree with you. I think it's one of the best ways to invest your retirement dollars. But about 11 years ago, I've been presented with the opportunity to buy a property in Phoenix. It was a fixer-upper, slight fixer-upper. And at that time, I did not have the money in my savings to buy that property. But it was a great opportunity. I did not want to pass that on. And I ended up buying that property inside of my Roth. Now, generally, I like to buy real estate personally so that I can take advantage of the depreciation deduction. But I couldn't do it. I didn't have any money to do that. And so I ended up buying that inside of a Roth. I paid $110 for it, put $10,000 in it, and fix up. It was rented at $895 at the time. And now in 2024, 11 years later, that property is worth just under $400,000. And the rent is $2,000. Now, keep in mind, this is inside of my Roth account. So all that gain, all that appreciation will be tax-free. All the income that I've been receiving and then reinvesting over the years also will be tax-free. So to answer your question, Will, is it really depends. Like Matt said, you got to look at your solo 401k and see what the options are. And you don't want to compare it with your taxable account, with your personal savings, because those are two different things. And it's like comparing potatoes and oranges. They are two different things, right? If you have potatoes, there is one purpose for that. If you have oranges, that's a different purpose. And so for you, Will, or anybody who listen, if you have personal savings, buy real estate. By all means, buy real estate. But if you have money inside of a retirement account, like Matt said, what's the best way that you can put your money? What's the best return it can produce? Is it stock market, or is it buying real estate, or is it doing private lending? And then you have to answer that question individually for a 401k specifically, kind of unrelated to your personal. You got to do both, I think. So
yeah, love that story.
All right, next question from Robert. Can you please go over the taxes involved if using investment property owned in a solo K as a short-term rental, and how to mitigate those taxes?
Well, I mean, short-term rentals, so for most investors, they are just rental income. So there's really not anything different than long-term rentals within a retirement account. The only concerns we have in the retirement account is this UDFI. If so, you're using leverage to buy the short-term rental, and similar to long-term rentals, you potentially have UDFI taxes. But outside of that,
but I think he said he's got a solo case. That's doesn't matter.
That's true.
Okay,
so the short-term rental, long-term rental, there's not really any tax downside to investing in the short-term versus the long-term. I think what you might be alluding to is, there are instances where a short-term rental operates more like a hotel business. We rarely see this, but there are examples of it where you're doing more than just like Airbnb. You're also providing your guests with like excursions and daily meal service and airport pickup. So once you start offering those types of services, then it starts to look more like a business, and that's where we sometimes are hit with UBIT taxes, regulated business income tax, where you're operating a business. It's no longer just like an investment. So that's really the only kind of downside I can think of. But again, very, very rarely do we see people operating short-term rentals to that level where it's not treated like a hotel.
The only other thing I'd add to that is, because we get this question sometimes, is if you do buy a short-term rental in your solo 401k, a lot of times when people buy short-term rentals or vacation homes, whatever you want to call it, one of their perks is they want to be able to stay in there off and on for their family and use it and rent it out. You can do that if you own that property personally, but if you own that property in your solo 401k, you cannot use it personally at all. That would be a prohibited transaction that could subject your whole, or that retirement account to potential distributions, taxes, penalties, all the above. So watch out for that.
That's a good one. Yeah.
I think to summarize, Robert, if you do have a short-term rental, unless you're offering like daily meal services and things like that, it will be treated just as a rental, and there shouldn't be any tax implications in the 401k. And Robert actually has a follow-up question regarding the depreciation that will be captured when selling the property.
Yeah, I mean, if it's in your solo 401k, there is going to be no depreciation recapture, because you didn't really benefit from the depreciation when you likely didn't even take depreciation on it if it's inside your 401k, and because you're not paying UDFI taxes, so it's kind of like a mute point.
Yeah, that's correct. Next question from Travis. Did he say you cannot do solo 401k with just a short-term rental?
So if you again, going back to that situation, if you're just doing a regular rental property like long-term rental or short-term rental where you're not providing hotel type services, it's really like in the IRS eyes, it's not really a business. So you wouldn't be that type of activity wouldn't allow you to have a solo 401k. Now, if you did happen to be doing short-term rentals in a retirement account that are providing hotel type services, that is treated more like a business. There can be, theoretically, if you were doing that type of thing, I guess you could have a solo 401k on the side because that would be active income.
I think the question is, can you fund can you contribute to a solo K with just the short-term rental? The answer is no. You have to have some type of income that you're paying self-employment or payroll taxes on. So if you are managing short-term rentals for another investor, that is property management income, you can use a solo K to, fund. You can fund a solo K with property management income for sure. To reduce taxes. But yeah, if this is the rental income itself, it's not income eligible for contributions.
The bottom line, since this is my area of expertise, the qualification for a solo 401k, Travis, or anyone else who listen, is that you have to have legitimate self-employment activity that generates earned income. So passive income is not going to work. Rentals that's passive income. You have to have earned income, and however you're going to structure that, whether it's a management fee that you collect or something else, that you got to talk to your CPA. But the bottom line, you got to show earned self-employment income. Schedule C income, not Schedule E, because Schedule E is not going to work for a solo 401k. All right, moving on to Nate. Is there any additional tax advantages for Section 8 or affordable housing investing?
I think income tax purposes, not really. Of course, there's always like tax credits and stuff, right? So that's something to look out for if you're doing affordable housing, low income housing. Depending on where you are, there could be low housing income tax credits that might be available. So we usually don't see those inside of a retirement account for that specific reason.
All right, next from Vasu. If I have full-time with 401k offered by my employer, and can I still have solo 401k from my side gig income on my own LLC?
So yeah, if you have a working full-time W-2 job and your employer is offering you a 401k account, can you still have a solo K from a side gig? The answer is absolutely yes. That's the beauty of it. Now you may be limited in terms of if you're doing the full employee bucket through your regular 401k. That would limit how much employee bucket you could put in your solo 401k, but you can still have it and still be able to do the employer side in your solo 401k. So definitely worth looking into if you find yourself in that situation.
Thanks. Totally agree with that answer. Next question from Robert. You mentioned deductions for properties owned in a solo 401k. How will those benefits when solo 401k is tax deferred already anyway?
I think we just covered that part, right? So it's not really the deductions we were talking about are outside of the solo. This regular rentals you own are in your LLC. The first whole part of our teaching today was not about real estate in the 401k. It's about non-401k real estate. And it's only the second part when we talked about the contributions and stuff, that's the 401k piece. So yeah, all those are outside of the 401k.
Maybe it's a little bit going off way here, Robert, but for those people who listen and just want to learn, with solo 401k, there's really no deductions that you can claim. What you can do is you can possibly claim deduction for an IRA. So if you have a self-directed IRA and you buy a property there, as you guys explained, there will be some UBIT implications on income that derive from the leveraged portion of the property. So there will be taxes that IRA will own. Then you can use the expenses to offset that tax liability. That when the deductions can apply in an IRA, not in a 401k. Am I correct?
You got it.
All right, next Will is asking, I'm in a position where I might liquidate the property just due to having the capital for something else. Okay, I'm not sure if it's a question, just a comment here. Clarification on previous depreciation question. I was referring to outside of a 401k. Robert.
Oh, okay. Depreciation recapture. I mean, yeah, if you sell your properties, usually you pay depreciation recapture tax, which just means, whatever you have depreciated that reduced your original cost basis. So that turns into gain if you're selling for a gain. Depreciation taxes, exist in most rentals that you sell. Now, there's a couple of different ways to offset it or defer it. If you do a 1031 exchange, for example, you might be able to defer that depreciation recapture tax. Or if you're using another offset strategy, let's say I have sold my property for a gain, I'm investing in some other properties or a syndication that's kicking off losses. If I don't have a net gain, then usually there's no depreciation recapture. So, but that's a whole 8-hour topic we can get into by itself.
Nice. Guys, looks like we have one final question left. So this is your opportunity to type your question if you want tax experts' opinion on your situation. But here we have a question from Robert. What is the amount that one will be able to have as income from their 401k account, and what is the tax for that income?
What's the amount that one would be able to have as income from the 401k account?
I'm sure I understand the question.
There's not really
The question is a little bit
percent.
unclear. Maybe I'm going to try to read between the lines here. If you have a 401k at retirement, you can start taking distribution, and it's up to you how much you can take as a distribution. And you can take, portion. You can take 20,000 a year, 50,000 a year, 100,000 a year, and that will be the taxable amount. The rest continues to be sheltered and grow tax deferred. But how much you can take from your 401k, that's up to you.
Yeah.
Right. Well, Matt and Amanda, thanks for joining us. Great presentation. Enjoy some questions. Great discussion here. As always, a lot of wisdom from you guys. Thanks for joining us. We'll bring you back in a few months because it's always beneficial to hear from you. There's a plot going on for you guys, and thank you all for joining us. Amanda and Matt, how can people get in touch with you? What can they follow you?
Yeah, I think, again, for those of you who are newer to tax planning or seeking tax help, you can go to our website at Keystone CPA.com. We have a lot of great free resources, and we always put our tax updates there as well. If you're looking for daily tax tips, we're also all over social media. I am on Instagram as Amanda Han CPA, and also LinkedIn, YouTube, pretty much everywhere.
And I'm sometimes behind her in those videos on Instagram. So
yeah, and Amanda,
thanks, Dmitry. Appreciate it.
Instagram, and you produce a lot of great content. So guys, you definitely want to follow Amanda on Instagram and just get daily tips on tax planning. That's sure will be helpful. Well, thanks again for joining, and you guys have a great rest of the day. We'll see you next time.